Hi friends, welcome to the Business Studies class. Today in this module, we are going to learn about the term financing decisions. The decisions is about the quantum of finance to be raised from various sources, that is from long term and short term. It involves the process of identifying various available sources. There are two types of main source of funds. They are shareholders' funds and borrowed funds. Shareholders' funds are equity capital and retained earnings. Borrowed funds are in the form of debentures of other form of debt. The cost of each finance is estimated. Some sources may be cheaper than the other. The financing decision is thus connected with the decision about how much to be raised from which source. Financing decisions involves impact on individuals or families' well-being. Well-being is the state of being happy, healthy and prosperous. For example, saving for a family vacation, spending money wisely, purchasing new items, etc. Now we are going to study the important factors which affecting the financing decisions of the company. The important factors are cost, the next point is risk, then flotation cost, then cash flow position of the business, then level of fixed operating cost, next control considerations, and last one state of capital market. First point is cost. The cost of getting funds through different sources are different. A manager would like to choose a cheaper source of funds. Second point is risk. Risk is the important element with different sources. Debt capital is the most risky, and from the point of view of risk, it should not be used. Then third point is flotation cost. From the point of view of floating cost, retained profit is the most appropriate source. Therefore, its use should be made. Higher the flotation cost, less attractive the source. Next point is flotation cost. From the point of view of the floating cost, retained profits is the most appropriate source. Therefore, its uses should be made. The next point is cash flow position. A stronger cash flow position of the business raises debt financing more than raising funds through equity. If the cash flow position of the company is good, the payment of interest on the debt and the refund of capital can be easily made. Therefore, in order to take advantage of cheap finance, debt capital can be given priority. Next important factor which affecting the financial decisions of the company is control considerations. Raising funds through equity may lead dilution of manager control over the business. Debt financing has no such implications. The ultimate control of the company is that of the equity shareholders. Greater the number of the equity shareholders, the greater will be the control in the hands of more people. This is not a good situation. Therefore, from this point of view, the equity share should be avoided. Next point is fixed operating cost. Fixed operating cost includes rent of the building, payment of salary, insurance premium, etc. Then fixed financial cost. It includes interest on debenture, etc. If the level of fixed operating cost is in excess, it is better to keep the fixed financial cost at their minimum. Therefore, debt capital should not be used. On the contrary, if the level of fixed operating cost is low, the use of debt capital is profitable. If the business has high fixed operating cost, lower debt financing is better. If fixed operating cost is less, more of debt financing may be preferred. The last point is state of capital market. Health of the capital market also affects the choice of source of funds. When stock market is at top, more people are ready to invest in equity. However, down capital market would make difficult for a company to issue equity shares. Cost factor, risk factor, flotation cost, cash flow position of the business, level of fixed operating cost, control considerations, and state of capital market. These are the important factors which affects the financing decisions of the company. Thank you.